Another benefit is that you, instead of the lender, get the opportunity to get that sweet, sweet interest. Okay. And so what happens is whenever you have an escrow account, you make payments into that account, and the lender actually gets the interest off of that money that you're sending them. Okay. It allows you the opportunity to put that tax payment, that insurance payment into a high yield savings account, and you to actually receive the interest that would accrue from that money instead of the lender.
Everyday people working 9 to 5, saving up that money, trying to survive, investing in the future, trying to be wise. We're gonna be money heroes. Yeah.
Hi, I'm Nik Johnson, host of Everyday Money Heroes, and I've reached early retirement. I'm here to provide information on how to obtain financial independence and inspire you through sharing stories of everyday people who are turning knowledge into freedom.
That hustle, always reaching for the sky. We're gonna be money heroes. Never gonna shy.
Hello and welcome to Everyday Money Heroes. We provide information and inspiration to people of all ages to take control of their financial journey. I'm your host, Nik Johnson, and today we're going to discuss mortgage escrows. Okay. Not only are we going to discuss mortgage escrows, I'm going to share why I decided to not use an escrow for my mortgage when I had a mortgage on my home, the benefits of not using escrow, and also if not using escrow is right for you. And I'll be honest with you, I think that not having escrow is something that many people can find benefit in, but we'll discuss that later on. And so before we get into that conversation, I definitely want to ask you, if you've not subscribed to the channel and you're watching me on YouTube, that you would do it there. If you're listening to the podcast, that you would follow Everyday Money Heroes there on your podcast platform of choice, that you'd also like and share this content as well. So now that we've discussed what we're going to, well, we've shared what we're going to discuss here in this episode, let's talk about what is escrow. A mortgage payment consists of four components, and you hear individuals call it PITI. All right, that's principal, interest, tax, insurance. Okay, the principal and interest is the portion that you're paying on the loan to the mortgage company. Then the T is the taxes, which is the property taxes. The I is the insurance that you pay to ensure that if anything happens to that piece of property, that the lender is made whole, and also that you as well can be made whole as well. As far as like if you have, um, things within the home, it'll try to make you whole in regards to that. So escrow holds the TI portion of the PITI. So it holds that taxes and insurance. And so that money is held in an account by the lender. Okay. And so whenever you go and you purchase a home, um, once you close, you actually pre-fund the first year's worth of taxes and insurance. So what happens is once you close on that property, they take that tax and insurance, they send it off to the lender. Then the lender takes care of all the other stuff as far as paying the taxes and the insurance. And what happens is that as you make your payments through the year, it actually takes those that TI portion of it and put it into that escrow account at the end of the year. Then it goes and actually pays it to the tax collector for your property taxes and the insurance company for your insurance. So that's the way it works. So why did I decide not to use escrow for my mortgage? So as far as why I decided to not use escrow for my mortgage, let me level set here also. Even when I had a mortgage on my primary home, I also had mortgages on some rental properties. So we have four rental properties, and we also have um, a primary residence. And so back when we had our first home, we were paying our mortgage, and I noticed that our insurance payment had took a really large jump. as far as like the actual premium for it. And I wanted to change insurance companies. So I wanted to shop around and try to get a better rate. So I looked around, found a better rate, and I reached out to the insurance company only to find out that the insurance company had already paid that next year's premium. And so I was not happy about that because they had found a better rate and I did not have any control over how that payment was made. And so I researched and saw what options I had. And I saw that there was an option where you could not escrow that taxes and insurance. So I reached out again to my lender saying, hey, you know what? I don't want to escrow this. What can I do? And because of the type of loan we had, not being able to escrow was not an option. Okay. But there are ways to get around that. I'm going to share that a little bit later on in this episode. So let's talk about the benefits that come with not using escrow. Uh, we did finally get to a situation where we did not escrow our taxes and insurance. So it gave us the freedom to be able to go around and shop for insurance. Okay, so and it was very easy. We just paid the whole full year. We went around, went to different insurance carriers and found what was right for us. So a big thing that was really easy to change. Um, Also, with the taxes, we were able to pay that as well. And so sometimes you can get a discount on paying your property taxes. Okay, so what does that look like? Here, where I live in Florida, is that our payments are due in April of every year, but they give you a discount the earlier you do it. So if you pay your next year's property taxes in the November of the year before it, they give you a 4% discount. And so we're able to ensure that we're actually getting a discount on our property taxes because we're actually paying it earlier than it's actually required to be paid. So every year we actually get a 4% discount on paying our property taxes. Okay. So we talked about how it's easy to change insurance. You have that control. You can possibly get a discount on your property taxes. Now, granted, every municipality is different. I'm just speaking to what mine does. But also, it decreases your debt to income, okay? Your DTI. You might say, hey, Kate, how is that even possible? Okay, so as I said before, your debt to income is called DTI. And so when you go and you actually go and you need to be approved for some type of credit, whether you're trying to get a new car or you might be trying to get another mortgage on your home or whatever, one of the things they take into consideration is your debt to income ratio, DTI. And so by not having your taxes and insurance escrowed, it reduces your DTI. And this is how that works. Whenever you go to be approved for some type of credit, they'll pull your credit report. Your mortgage payment will be on your credit report. When they pull that credit report and they see that mortgage payment, they just see a payment. They don't know if it is comprised of principal and interest or principal, interest, taxes, and insurance. And so by taking the taxes and insurance out of that payment, you're actually reducing your mortgage payment, which in turn reduces your debt to income ratio. Okay. So say for instance, you might have a $2,000 a month mortgage payment. $500 of that could easily be taxes and insurance. And so by not having that payment included in it, not having that escrow, it could reduce it down to $1,500 a month, then ultimately reducing your debt to income ratio, which could improve or would improve your likelihood of being approved for additional credit. Okay, so that's a benefit in itself. Another benefit is that you, instead of the lender, get the opportunity to get that sweet, sweet interest. Okay. And so what happens is whenever you have an escrow account, you make payments into that account, and the lender actually gets the interest off of that money that you're sending them. Okay. it allows you the opportunity to put that tax payment, that insurance payment into a high yield savings account and you to actually receive the interest that would accrue from that money instead of the lender. That is a win. Also, what we like to do, and this is a bit of a hack, is that we use our property insurance payment every year to meet the minimum spend on a new credit card to get the sign up bonus. We do it every year. And so that allows us to do is that money that we're already going to be spending, we just use it as part of the minimum spend. We intentionally and strategically open up a credit card knowing that the minimum spend we can easily achieve and use that property insurance payment as a large part of that sign-on bonus minimum pay. And so we're saving that money all year. We're getting the interest from our high yield savings account. We're then making that payment because there is not a convenience fee for paying your property insurance on a credit card. So we'll go ahead, we'll make that payment. We'll take the money that's been sitting in that high yield savings account, pay that off in full, and then we just wait for whatever that sign on bonus is, whether it's points. We typically like to use it for points to go travel. It could be just for some type of cash sign on bonus. It could be anything. And so that allows you more flexibility there. Now, I do know of some individuals who actually use their credit card to pay for their property taxes. I personally don't like to do it because there's usually some type of service fee or convenience fee. It might be 1% or something like that. It could possibly be worth it if you're really close to meeting the minimum spend for a bonus on a credit card. But I typically don't like to do it because I don't like to give back, that service fee for paying property taxes. So that is a great benefit or a great hack that you can use for paying for your property insurance and or property taxes. All right. So since I told you about some of the benefits of not having escrow, let's talk about how to remove escrow. Okay. So when we when I first reached out to try to get the escrow removed from our mortgage, we were not able to do it because of the type of loan that we had. We had a first time home buyers. We were in a first time home buyers program. So they were very specific about having to have an escrow account. But some time it went by, it had been a few years, and we had actually had some equity to build in the home. Rates had gone down. And so we were going to refinance our home mortgage. And so as we were going out and shopping for a mortgage, one of the requirements that I told the mortgage broker is that we had to have a mortgage that would allow us to not escrow. Okay. And we were fortunate where we had enough equity in our home where we can get a conventional loan. We didn't have to get another FHA loan. And so we were able to get a conventional loan and we were able to waive escrow. Okay, so that's how we were able to remove escrow. So we weren't able to remove it from the actual loan that we had, but we were able to refi. And when we refied into a product that didn't require to have escrow. Okay, so there's also a caveat to that. When we decided to waive our escrow, there was a fee we had to pay. Okay, so the fee that we had to pay was a quarter of a point. So when we went and we did refinance, we had to bring a quarter of a point to the table for the waiver of escrow. And so, just for instance, if you have a $200,000 mortgage, a quarter of a point would be $500. Okay, so you bring that. Why does the lender require you to do that in that case? Because the lender is forfeiting the interest that they would get if there was an escrow set up. So they're like, hey, we got to get something out of this deal. So what happens is that they will allow you to do it in those cases, but they're like, hey, you got to bring something to the table. So we had to go and bring a quarter of a point for our mortgage. Okay. So you might say, what? I have a really awesome rate. I'm not trying to refinance anytime soon. Do I have options? there may be some options for you. Okay. You can reach out to your lender and you can ask if there's a possibility for an escrow waiver. Okay. Depending on your product, you could or could not do it depending on the stipulations of your mortgage. Also, there are options where something that's called a partial waiver. A partial waiver. A partial waiver will allow you to maybe do tax only or insurance only waivers. So, for example, if you say, hey, you know what? Can I at least get a waiver for my insurance so I can go and I can shop for my own insurance every year? That way I want to keep the cost down. They may be willing to do that. Some other ones might do maybe just taxes only. So you may not know what options that you have until you call your lender. So just reach out and just ask them, what options you do have. So I've discussed the benefits of escrow, how to remove escrow. But let's talk about if not using escrow is right for you. Okay. So first of all, if you have a conventional loan, it's a good chance that you can get an escrow waiver. So you can reach out and ask them. So typically, I haven't heard of there being any real issues with conventional loans. And a conventional loan is a loan in which you have at least 20% equity in the property. Okay. Now you can have an FHA loan and still have 20% worth of equity in the home, but still not be able to do it because technically, if it originates as an FHA loan, it's an FHA loan. So that's just what it is. And so in talking about if not using escrow is right for you, if you have an FHA loan, typically the case of that is no. So FHA guidelines usually require an escrow account for the life of the loan. Okay. You might have a USDA loan similar to FHA loan. Typically, they require escrow for the life of the loan. VA loans a possibility. I know my parents went and my dad used this VA loan some years ago. He tried to waive the escrow and he said, you know what, we're not able to do it. And so I've heard that some people you can't. So definitely just ask. Also, the final thing I want you to think about is if not using escrow is right for you, is that if you're still working on building up your saving muscle, this may not be a good option for you. Why am I saying that? There is no benefit that is worth losing your home if you don't have the discipline to hold escrow yourself. And so what happens is that if you don't pay your property insurance, the lender will then place insurance on you. So you'll have forced placed insurance. Forced placed insurance is horrible. It's typically 2 to 3 times what you'll get from a regular policy. And that policy is only beneficial to the lender. Okay. And so basically they're insuring the property. They add it back to your mortgage payment. So then you're going to still be dealing with some type of escrow, but it's going to be extremely high. Okay. So you don't want forced placed insurance. Second thing is if you don't pay your property taxes, what will happen is that in most municipalities, they'll have a property tax auction. What will happen is that someone will go and pay your property taxes. There will be a lien on your property until you pay those property taxes. And depending on your municipality, after a certain number of years, if you don't pay that property tax, they can actually apply for a deed on your property, which would be a tax deed for your property. And if they get granted that tax deed, they will own your home, but you will still be responsible for the mortgage. Okay. So we don't want that. So definitely, if you hear all the benefits that are here, but if you feel as though that you would struggle to be able to maintain making the payments on your own in regards to your property insurance and your taxes, I encourage you to wait to do this until you have that saving muscle and the discipline to be able to do that. Okay. And so I just want to share this with you as far as why I decided to not use escrow on our property when we had a mortgage. We still have some rentals and we still don't use escrow. We pay it every year. We get that discount. And also we are using that lump sum payment for our property insurance to meet the minimum spend for credit card bonuses. So this can be a really great tool if you have the discipline to use it. So that being said, I'm going to sign off here. My name is Nik Johnson. I want to thank you for your time. If you have not done so, I'll ask you again to subscribe if you're watching us on YouTube and to follow us on your platform of choice if you're listening to us on via podcast. And as always, I'm going to remind you to trust the process. Have a great day.